Good evening. My name is Bernardo Mariano. I'm a partner at Equity Research Desk. Basically, let me introduce myself for those who don't know us. Basically, we do research, consulting, and investment banking on exchanges globally. We done consulting for exchanges in Europe, US, Asia, Middle East. Tonight, there's too much technology here, so I don't know which one I need to hold them. So tonight I'm going to talk about, this works? Yeah, it works. Today they asked me to talk about the merger between ICE and New York Euronext, and they asked me to make it entertaining and interesting. I'm sorry to tell you, I'm not good at telling jokes, so if you want to leave early the conference because you don't expect my presentation to be interesting, this is the time to do it. Let me warn you that if you do so, I'm going to put you on the spot right away. So sit tight and enjoy the ride. Let's start. Let's jump into it. Basically, the New York and ICE merger. It's a transatlantic integration. Who said that, basically, in 2006? Tain, when he was acquiring Euronext, basically, based on the promise of a lot of value delivered to shareholders. Well, after 6 years, instead of, I would say, a transatlantic integration for the shareholders, was a transatlantic disintegration, because about $12 billion in value was lost of shareholders. But tonight, instead, in order to not to make it too boring, the presentation, instead of focusing on the numbers of the merger, I want to try to look at the qualitative reasons why this merger took place, basically, and why Sprecher, the CEO of ICE, decided to acquire New York Euronext, basically. Well, in the last couple of years, ICE has enjoyed favorable growth conditions with the rise in the interest in commodities and the demand in commodities. And that can be seen very easily if you look at a rise in the value of commodity index futures of 68% per year. From 2003 to 2008, it went from 15 billion to 200 billion. This interesting commodity, as you know, ICE is mainly an energy exchange, basically, and trades about 30% of the revenues come from on-exchange energy trading, WTI, Brent, mainly Brent, and then OTC energy contracts. That interest in energy has propelled the increase in volumes at ICE at about 20% per year between 2006 and 2012. Also, favorable conditions included the displacement as WTI as a benchmark in favor of the Brent, basically also contributed to the increase in volumes of ICE, because, as I said, although it's an energy exchange, it mainly trades, the main contract traded there is Brent. Another favorable condition that benefited the increase in volumes and the success of this exchange in the last couple of years in energy also was the regulatory developments. As an example, this is the UNG ETF. The UNG is the gas ETF traded in the US. Basically, shifted to FSA-regulated ICE contracts after the CFTC threatened to establish a limit on March 2009. Look what happened, and this is a very interesting graph for the regulators to take into account. Just by threatening, basically, to regulate, to establish limits on U.S. regulated contracts, the UNG ETF shifted its volumes to FSA-regulated I contracts. You see this green area is basically the ICE ECM SPDC contract, which is regulated by the FSA. And instead of increasing in July, the amount of volume in the other two contracts, which are traded in CME and are regulated by the U.S. regulator, they start, taking the volume to another jurisdiction. All this basically made propel growth in revenues at ICE. You see, compared to CME, its main competitor, in 2007, revenues grew 83%, 42%. But as you see, we expect this to change. Why we expect this to change? Not because we expect commodities prices to go down, but we expect the macro to change overall. And we expect, although commodities prices we think they're going to keep going up, they're going to keep going up for different reasons. Not for an increased demand, but because of a change. We're going to start seeing the macro effects of the monetary policy of the US, Europe, and the different countries in the last couple of years. So basically, also, as revenue increases, earnings increases. Basically, you see here how earnings grew compared to CME. But we expect that to change. And why we expect that to change? And that's we think that's Spreaker, that's why he was so interested in acquiring Life. Because in the next cycle, when basically we're going to start seeing the effects of the monetary policy implemented by the different countries, we're going to see prices to go up of all the commodities and of all assets, and therefore people will have to hedge. And here is a very important, although it's a boring slide, not as interesting as the others, this is a very important slide. And here is the important part. We think that the demand for commodities, it's not going to grow like it grew in the last 60 years, about 70% per year. We think the prices of commodities are going to go up, but also the prices of other assets that need to be hedged, and like mortgages or real estate, and you hedge that through interest rate contracts, will also go up. But when you look at an exchange that trades commodities or interest rate contracts in an environment where people will need to hedge the increase in prices, which one of these two type of contracts is most profitable? And this is a very good insight. I don't know if all of you have looked at this. But when you trade a commodity, you trade a quantity of barrels, of bushels. So therefore, if the price of the barrel goes up, you still, in order to hedge that barrel, you still need one single contract. On the other hand, when you need to hedge a mortgage or a mortgage that is real estate, because and real estate start going up, let's say and you need an interest rate contract to hedge an X value, like let's say $100,000. I'm buying a house that has $100,000. I have a mortgage on that house over $100,000, and now I need a contract to hedge that. If the price of the property goes up, now the amount of the mortgage, let's say the property is $100,000, now it goes to $200,000. Now, instead of one contract to hedge that mortgage, I'm going to need two contracts. So what's going to happen here, although we expect, because the effects of the monetary policy will have a big impact, we've already seen a price in assets, and we expect interest rates to start going up, it's going to be more beneficial for an exchange that trades interest rate derivatives. And that's why what Spreaker saw in New York, in Life. And that's why he's so interested, and he's already tried, this is the second time he's trying to acquire Life. Okay? So that's the crown jewel that he's really looking into it. So, and the good thing about acquiring at this time, this point in time, Life, is that he's buying a very cheap asset, because volumes in interest rate derivatives, because of the zero rate policy that we've seen almost in the US and very, very, very close in Europe, has shrink the volumes in the exchanges where interest rate contracts are traded. Same thing is happening at CME. Basically, volumes are at basically the lowest point. And this is a very good example of what we expect to happen. Japan. When Sancho securities went down in '97, you know, they have a huge contraction in the financial markets in Japan. And basically, the Bank of Japan changed its rate policy to a zero rate policy. Oh, sorry. Changed its policy to a zero rate policy. Very similar to what's happening in the US and very similar to Europe. Basically, volumes in TFX Eurogen went almost to zero, almost disappear. And what happened, but one interesting thing is that you don't need inflation to kick in to have an increase in volumes. So here, look at here. So volumes went down from 86% from 95. Sanjo Securities, which is Lehman, we can compare it to Lehman, went down in 97, okay? Volumes went down 86%. And basically, the reason it was the banks needed to be recapitalized in Japan. So basically, the capital of the banks shrunk, like in the US, like in Europe, and basically the amount of volume was reduced. But when volumes came back in Japan, it wasn't due to the recapitalization of the banks. It was simply inflation expectations and expectations of interest rates increase. Look at this. Oops. Look at this. The Bank of Japan changes its rate policy. It started to change its rate policy in July 2006. But look what happened in 2005, way before they changed the rate policy. Volumes started to come back. And guess what? Volumes reach a new all-time high once the Bank of Japan changed its rate policy. So imagine, here we're talking, so here we're talking about Europe, and the same thing to CME, where most of the contracts, international contracts, are based either in dollars or in euros. So not only, in the case of Japan, it was a much more local effect, like contracts are more local, written in yens. Not many international contracts are written in yens. Here we're talking about euros, and a lot of more contracts around the world are written in euros than in yens. So we expect, and also we expect the same thing for CME, for volumes of life to really reach a new time highs when interest rate expectations start changing. Even though we expect some change in the volumes of life, but just by once the recapitalization of the European banks is completed. Like in the US, if you look at here, once the TAR program was basically completed, we saw some volumes increase in the CME. So Spreaker is buying a great asset at a great time because we think it's really undervalued. But it doesn't. It comes with a baggage, unfortunately, that great asset. Okay, which investors don't like that much. Okay, and so we doubt that a commodities exchange like ICE can deliver on the promises of wonderful returns for investors, like Tang promised those wonderful things about 24-hour trading, transatlantic integration. So it could be a huge mismatch as transatlantic integration could not deliver on the promises it promised. We think a commodities exchange, because this is commodities, there's not much synergies with the commodities exchange and a cash equities exchange. So we're very doubtful that although there's a great value in that asset within life, that those benefit, if they stick with the structure the way it is, they're going to be able to deliver those that unlock that value to shareholders. And let me give you an example. The average merger among exchanges, historically, these are expense synergies, and these are all mergers. Russia, Bovespa, BMNF, CME, CBOT, all in the last big mergers in the last 7 years, promise synergies in average of 36% on the expenses of the acquired exchange, and an average of 11% in revenues of the purchased entity. In the case of ICE and New York, they're only promising 19% of synergies. So that tells you already there's not too much. The fit is it's not that good compared to other mergers. So what are the alternatives that Springer has before the deal is completed? And we think there's possibility here to unlock value not only for the shareholders of ICE, but for another exchange. We argue that the best thing that ICE can do, Springer can do, is to bring to the table the CBOE, basically, which is an option exchange. And that's a great complement for a cash equity market like New York. We know that it's been already discussed on the newspaper that the Euronext portion is going to probably be sold or through an IPO, but they still have the New York. So if they do that, if they bring CBOT, here is the deal as it is today, basically. 300 million in synergies, and with the value of the shares of 148, they are 153, I think, today 152. If they bring CBOE to the table, basically, which I think is a great fit, they could unlock another 100 million in synergies, CBOE, with New York, acquiring New York. And we think then that basically would improve the multiple of the ICE, because as you know, the multiples of cash exchanges are much lower than multiples of derivatives exchanges. Okay, so they can basically, the share value could go up to 179 and from 153, which is today, and the CBOE, I think, is 30 something. Its share price could go to 43. So basically, we think in order to do this, they have to do it before the deal is closed, because the regulators in the US, as we have spoken to people close to the regulators in the DOJ and regulators in the US, they feel that the regulators would not allow ICE to flip New York because of the national, import interest that New York has for the country, to flip it around after the deal is closed. So they would have to do that before this. So basically, looking at other exchanges, we think that's the only one, because NASDAQ, as you know, they already tried together with ICE, but it was blocked by the regulators because on antitrust issues. So in this case, we don't think, because CBOE doesn't trade equities, trades options, which is also a very competitive market, so they understand very well competition. It's a great fit, and it would unlock a lot of value for both shareholders, ICE shareholders and CBOE shareholders. And I hope I made something that could be boring, if we do numbers, interesting. Thank you very much.